Good evening, everybody. Can you hear me? Hi, thank you. Thank you for your answers. Okay, let's give a couple of minutes. I can see there's a few people still trying to join. So let's give them a few more minutes to join before we start the class. If you remember well, last class we reviewed the M&A pitch, which is a presentation, a meeting done by investment bankers to try and sell their proposal to advise either a buyer or a seller in a transaction, in an M&A transaction. So we discussed the contents of an M&A pitch, and we discussed and we reviewed in detail an example of an M&A pitch on the sell side, for the sell side. So we will start today's class reviewing an example of an M&A pitch of a document done on the buy side, and then we'll continue with today's topic, which is the internal preparation of a company for an M&A process, and give you the guidelines for our case study, which is what we will be doing for the rest of the course. Okay? So maybe one more minute while I start the presentation, so then we can start with today's class. Hopefully today we have a better connection. I can see, at least on my side, there is definitely a better connection. So hopefully we don't have the interruptions we had last class. Please let me know if you don't hear me properly, or if you have any problems to hear me well. Okay? So let's see, maybe just one more minute for the rest of the group to join. I see. Okay, I think we can start now. We've got most of the class already logged in. Okay, so as I said, we will start reviewing an M&A pitch presentation. As I told you before, every class, the documents I show you every class are based on real transactions. So the document we saw last class for an M&A pitch on the sell side was a real pitch, a real document, a real presentation. Obviously, the meeting and the presentation was used for this meeting. And in the same way, I will show you an example of an M&A pitch presentation done for a client on the buy side. And you will see it is very different, because on a sell side, you want to let the client know that you as a banker are, let's say, an expert managing processes, that you can help them prepare the company for a sale process, prepare the company nicely to market it well, give them some ideas on who is going to be doing which kind of work to prepare the company, how long the process will take, the structure, and then you're going to be telling them how much the company is worth, who are the potential buyers for this company, and the credentials that you as an investment banker or as a bank have in that sector, etc., etc. On the buy side, it's a little bit different, because even though you want to explain everything related to the process, the buyer also, and most importantly, wants to know how well you know the sector, how well you know the company, because you're going to be doing a very in-depth analysis and valuation of the company, and they want to make sure that if they make an offer, they make an offer for the right price. Okay, So this is an example of a pitch for the buy side, okay? So this was a bit more earlier in the process. There was no official process, and we were doing a pitch to participate in a specific process. It was just, let's say, a coverage presentation where bankers meet with a client and they discuss the sector, they discuss the knowledge of their sector, and then they say what opportunities could be potentially for sale, okay? So this is a sort of introduction. So this presentation was a discussion on the Peruvian microfinance sector, okay? So let's quickly go through the details and see what was included, okay? Let's zoom in a little bit. So there is an introduction, there is an overview of the Peruvian macro figures. So probably this is I will switch off the camera so people get a better connection while we discuss the presentation. Okay, a discussion of the Peruvian, let's say, economy, a discussion of the Peruvian financial sector, a discussion of or a review of the microfinance sector, and then some legal consideration, and then some opportunities specifically targeted to the client to which we were doing the presentation, okay? Okay, so a brief introduction. To say that the bank appreciates the opportunity to meet, what the presentation includes, so an overview of the microfinance sector, some figures regarding the penetration of the market, some figures regarding the M&A activity that has been going through in the sector, some comments regarding competition, and then mentioning that some opportunities that could be available in that sector. Okay, then as you can see, a brief overview of the Peruvian economy. That presentation was done in 2011, so some historical figures and projections of GDP, inflation, GDP per capita, and population and unemployment. So key economic figures, because it's obviously an international player, you need to show you have good knowledge of the Peruvian market. Then some more figures on the economy, foreign investment, the evolution of the FX rate, budget balance, so imports and exports, and public debt over GDP. Okay, then a focus on the financial system in the country. So what is the financial penetration in Peru compared to other countries in the region? What is the evolution of this penetration in terms of loans over GDP and deposits over GDP, which are the two main metrics in the financial system? Access to financial services compared to other countries in the region in terms of branches and in terms of ATMs or cajeros, and the penetration of microcredit or microfinance and number of clients as a percentage of the total system, okay? So some introduction to the financial system, to the Peruvian financial sector. Here you have an overview of the financial sector, commercial banks, savings banks, which are cajas municipales, financial companies financieras, rural savings bank, which are cajas rurales, pymes, Banco de la Nación, Agrobanco, and leasing companies. So all the financial sector, an overview. What's the size of the total loan portfolios, and what is the business mix in terms of corporate loans, mortgages, microfinance, consumer, etc. Obviously, I don't want you to focus on the details. I want you to see what level of detail is discussed in a presentation like this and what sort of analysis you need to do for this kind of meetings, or what you should expect if you are receiving an investment bank that is visiting you. what kind of analysis they can do for free to discuss in a meeting, okay? So an overview again of the financial sector, how it's split between commercial banks, savings banks, financieras, cajas rurales, etc., etc. And for you can see that 81% of the market in terms of assets corresponds to commercial banks, 85% in terms of loans, 80% in terms of deposits, but only 43% in terms of branches. So here you see that there are many branches that belong to savings banks and financieras, for example, but they hold, besides holding a large percentage of branches or offices, their market share in terms of loans and deposits is very low compared to what commercial banks hold, okay? This is a ranking of the whole financial sector. You have there banks, savings banks, financieras, and everything. You have, for example, to start the ranking, BCP, then you have BBU Continental, Scotiabank, Interbank. At that time, Mi Banco was not yet part of BCP, etc., etc. Okay, and what do you show? You show loans, market share, deposits, market share, branches, market share, and ownership. So a lot of detail for each of the players in the market. Who are the main key shareholders in each case, okay? So very detailed information and a lot of work, okay? What about the microfinance sector? So zooming in. What is the evolution of loans, deposits, and branches for each kind of financial institution? So here you have everything for microcredit. So here we had separate Mi Banco, cajas municipales, financieras, cajas rurales, and pymes, okay? So you can see the evolution of loans, the evolution of deposits, and the evolution of branches from 2006 to 2012, and you can see how most of them had grown incredibly, especially cajas municipales and financieras, in terms of both branches and loans, and in terms of deposits, also cajas municipales. All of them had grown, but you can see that they were going like very steep growth, okay? There was like a massive expansion. Okay, what about M&A activity? In the last 5 years, there had been all these acquisitions. So from the bottom to the top, Fundación BBVA had acquired Caja Nor Perú, Caja Sur, Crear, Scotiabank had acquired Banco del Trabajo, BCP had acquired Edificar, Grupo Jaramillo had acquired the Pyme Pro Negocios, Fundación BBVA also acquired Financiera Confianza, Compartamos, the Mexican group, had acquired Crear, and Financiera Universal had acquired Profinanzas. And some figures related to transaction value, branches, employees. There were no multiples because I think there was not a lot of information available, but still, this is very detailed information prepared for a client to get to know the system, okay? What about a ranking of the microfinance system itself, okay? So only including microfinance institutions. If you have a ranking in that way, you had Mi Banco, Credit Scotia, then Caja Municipal Arequipa, Edificar, Caja Municipal Caja Piura, and then you had some of the smallest rural banks, Nuestra Gente Más Confianza, that had merged, Trujillo, Sullana, Huancayo, etc. Okay, and the same here, loans, deposits, branches, and each one with market share and the ownership of each one. Then an overview of their geographical footprint in terms of branches or offices. In each region, so for example, here in orange, Tumbes and Piura, north of Peru, who were the top 3 ranked by branches? So here you could see that, for example, in the north, Caja Sullana and Caja Piura were very strong, obviously because they are both from Piura, Departamento de Piura, but you also had Edificar in 3rd place, okay? What about, for example, the light blue, which is Loreto and Ucayali. You had Caja Mainas, Caja Piura, and Financiera Efectiva. So interesting, because Piura, you could see also that even though they were mainly focused in the north of Peru, they had also expanded to the Amazon, or the Amazonic region, okay? And in the same way, you could see, for example, in Lima, Mi Banco was a clear leader, followed by Credit Scotia, and followed by Edificar. And in the bottom right-hand side, you could see the total. So in the whole country, the number one institution, or microfinance institution by branches, was Edificar, all over the country. Mi Banco was the second one, and Nuestra Gente was the third one, okay? And you can see that, for example, Mi Banco had 116 branches, but 58 of them, so almost half of them, were in Lima and Callao, while, for example, Edificar had 160 branches and only 36 in Lima and Callao, so they were maybe more in other provinces. Okay, just to see the level of detail of the analysis. Here you have a benchmarking analysis done of all the microfinance institutions, or the top 15 microfinance players in the country. So here you will have the evolution of some metrics. So for example, in the first blue line, you see the evolution of margins, net interest margin. In the second blue line, you see the evolution of ROE, return on equity. And in the third one, you see the evolution of return on assets. So 3 profitability metrics. The last 3 years, 2010, 2011, and 2012, for each one, what were their metrics and what was the average of the system. Okay, so let's, for example, look at ROE, the one in the middle. So we could see, for example, that Mi Banco had return on equity of 27%, then 26%, and in 2012 it had dropped to 11%. So something was going on with Mi Banco, okay? Credit Scotia, however, was 28, 27, 28, so pretty stable and very high. Look at Financiera Edificar, 35, 35, 40, or 39. And what is the average of the system if you go all the way to the right? 18%, 21%, 17%. Okay, so you could see and go to conclusions immediately of things that were happening in the sector. The return on equity is a profitability measure, and you can see that some institutions are going extremely well, like Edificar, that has an ROE of 35 to 40%, which is incredible, while the system is around 18 and 20, and you have others like Caja Municipalica that is at 10, Nuestra Gente 8%, and something happened to Mi Banco that has dropped from 25, 30% to 11%. Okay, so immediately after looking at some figures, you can start understanding the sector. And this is what bankers try to discuss with their clients, which obviously know much better the sector in general, but maybe not the companies in Peru. For example, this pitch was for an international player that knew very well the microfinance sector worldwide, or in other countries where they were present, but didn't know well the sector in Peru, okay? To follow the benchmarking analysis, there is not only profitability, but also efficiency, non-performing loans, and coverage, okay? So this is to see the asset efficiency, is to see the cost compared to the income, and then NPLs and coverage is to see the asset quality. So how many loans, or what percentage of loans are not being paid compared to the whole portfolio. So we will not go into that detail, but here as well, you can see, for example, Mi Banco, having non-performing loan of 3% or 4% had gone up to 4.5, okay? And for example, Caja de Luren was at almost 9% from 3%. So their portfolio or their asset quality was not doing well, or was was increasing, their non-performing loans were increasing, okay? So, also, loan to deposit, which is liquidity, how much of their deposits can be, how much of their loans can be funded with the deposit base that they have, and solvency, which is capital metrics, okay? So how well capitalized are they compared to what is required in terms of Peruvian banking system. The solvency requirement by later is 10%. Microfinance institutions are expected to be at above that level because they're more risky because of the nature of their portfolio. So you would expect them to have a capitalization of at least 15%. Okay, so there are a few here that were below that 15% level, some of them slightly above, some of them better. Okay, so you can do a very detailed analysis and discuss in a lot of detail with your client the situation of either a specific bank or the whole sector. After all this detailed analysis or financial analysis, some legal considerations for them to be aware of, some regulatory updates that had been either in the press or recent news or interesting things to know for an international player. And then, as we saw in the introduction, some strategic opportunities for that potential client to look at some companies or some banks or some microfinance institutions that could at that time be potentially up for sale. Okay, so we discussed at that time Mi Banco. That was the first one. So here you can see the market share evolution of Mi Banco in the last years in terms of loans, deposits, and branches, and their geographical footprint in terms of the number of branches that they had in each region. And a profile of Mi Banco with a lot more detail than only what was discussed in the initial part for the top 15, where you could see the detailed financials, P&L, which is income statement, BS, which is the balance sheet, and some key ratios with their evolution of the last 3 years. Information about shareholders, information in the left, a company description with a lot more detail, and a mix of their loan portfolio in the left and of their deposits. How is it broken down? What is the split of loans? What is the split of deposits? Okay, so a lot of detail, as you can see. And then even more detailed analysis of the loan portfolio. How had it evolved? What percentage is micro business, small business, consumer, mortgages? And how did the NPL or non-performing or morosidad had evolved in the last years by segment and by risk category, okay, and by currency, local currency, so dollars, soles, etc. And also an analysis of their funding profile. So how is their deposit base split, current accounts, savings accounts, term deposits, and how are they funded if it's not fully by deposits, interbank, debt, securities, issuances, etc. Okay, and maturities for each type. Okay, that for Mi Banco. The same analysis were received for Credit Scotia at that time, which was another institution that was at that moment that we saw potentially up for sale. Also for Caja Arequipa, even though it is a savings bank at that time, there was some changes in the requirements for savings banks, also for Piura, the same analysis, and for Nuestra Gente, that was then bought by BBVA. Okay, so here, as you can see, I have shown you a detailed example of an M&A pitch on the buy side. And what you can see is that you do a lot of work and a lot of analysis to meet with a client in a pitch. So if you are working, if you are working on in an investment or for an investment bank, you will be very familiar with this kind of meetings, either for the sell side or for the buy side. You will probably have to do a lot of work because it's the opportunity for you as a bank to sell yourself and sell your advice capabilities with a client. As you saw last time, obviously you can include credentials, who you are, and everything. But what is most important when you are doing a pitch on the buy side is that you show your potential client that you know very well the market, that you can discuss the market in detail, that you can help them very well to get to know and to understand very well the target or the target company. Okay? On the presentation we saw last class, you can see it was a lot more focused on the process itself because it's what you want to sell a client on the sell side. Okay? Obviously, you can do a presentation that combines both. I showed you sort of an extreme presentations on each side. But this is an answering our last question. Yes, this is a presentation. This is an initial presentation, which is showing one of the first meetings with this client where we wanted to show our knowledge of the market. Obviously, you want to hear from them what are their views. You want to see them, what is their reaction regarding these potential opportunities. And obviously, if they say, for example, yes, we like very much Mi Banco and think there is a lot of fit for us, and then you can do a second meeting, a second presentation where you discuss in a lot more detail only Mi Banco, and then you do like a side-by-side with their own company, and then you can do an analysis of how they would look like if they acquire this company, and then you can start giving also some metrics regarding potential valuation, as we did with a seller, in terms of multiples, etc. And you can also start talking about the potential processing, who you also think could be interested in this company as well. Okay? So I think with that, you should have a pretty good idea of what an M&A pitch document presentation can look like, and maybe what you can expect if you are, let's say, if you work for a company and you are thinking of participating in a process, and you ask an investment bank to meet and to present you some ideas, they should be doing some good work to present you something helpful and to try to convince you that they are good at it, that they know the sector, and that you should hire them. Okay? So it's always good to know that you have the possibility to get all this information for free, because they will do all this presentation without asking for any money. Obviously, they want you to hire them in the future if you ever do a transaction. So you can meet with them as many times as you like, and you can get some very good information. And if you like some investment bank better, or you think that they know the sector better, you can meet with all of them, and then you can decide if you do a transaction, who you want to choose. Okay, this is perfectly normal in the market, and you should know it is there, and you should use it, because it's very good information that you can get, even if you don't end up hiring them. At least get to know them and listen to them, because they can give you very good insight of the market, of the competition, of the sector. Also, if you're interested in entering a new sector or a new market, it's also good to call them, because they will probably have a lot of information that they can share with you for free. Okay? So let's start with today's class, where we will come back to our initial slide with the typical M&A process. Okay, just to repeat for those of you that join later on that today we're going to discuss the internal, how the company starts preparing before a sales process. So the internal preparation of the company before you launch an M&A process. And we are also going to discuss at the end of the class the simulation case that we're going to be doing during this course, and the deliverables that you will have, and the specific dates, etc. All the details. Okay? So if we come back to our typical timetable today, sorry. It is not responding very well. Okay, there we go. As you can see, the first stage in phase 1 is the internal preparation of the company. Okay, where we have a due diligence call or meeting with the sellers or the client to start understanding the company, discuss with them the business, etc. Site visits or visits of the plant or the infrastructure or the stores, or depending on what kind of company it is. The meeting with client. Then you discuss potential buyers, and you do a financial analysis and an internal due diligence of the company. This is all done by the bankers and the company itself. And you finish this internal preparation phase with the valuation of the company. Okay? So to understand where what we will be focusing on today. Okay? So this is the preparation of the company to start a process. So I will turn off the camera and we will focus on the presentation. Okay, so to start with the internal preparation of the company, you need to sit down with your client, with a seller, and either top management or the owner himself, if he's the one that knows very well the company, and discussing a lot of detail, not only how the company has done in the past, so the historical figures and the historical performance of the company, but also the strategy of the company in the future and their business plan, okay? And together, you need to prepare a credible business plan. Sometimes companies have their budget for the following year. Sometimes they have a 2 or 3 year business plan or budget. Usually, companies have only the budget for next year, for the following year, and not always. You would be impressed to know how many companies do not have a lot of planification ahead. But a company that has relative size and time in the market usually has at least a budget for next year. Okay, so you need to sit with them, discuss this budget, and discuss the strategy of the company, the opportunities for growth. You need to potential areas for growth, the strategy to see how this company may evolve in the future, and where do you see together that you can have some more value added or some, let's say, path for growth, okay? And based on this, you sit down and discuss these potential areas for growth, let's say, and try to put them down in terms of projections. Okay, so you try to understand how do you think, or how does the management and company believe this company is going to do in the future, and then try to bring this down to figures. Okay, so project their sales, project their cost structure, and project their the way they have doing business, and project the different business lines, if there are different business lines, or if there are any opportunities of growth. Try to see how this could look in the future, and try to build together, let's say, at least 5-year business plan. Okay? This is done, as you say here, identifying the key value drivers, identifying the strengths and weaknesses, and understanding how management and sellers or owners see the future of the business. How do they see competition? How do they see the market, etc., etc., etc. Okay? So basically, this comes down to projecting an income statement. Depending on the sector the company is in, you can either project only income statement for most companies, or you can project both income statement and sheet if it is a financial company. Okay, there is a question. Okay, so they're asking me what are one-offs. Let's come back. You probably saw it in the... Okay, here we have a comment. Let's go through the comments, okay? You develop a business plan together with management and expertise of the sector. You identify potential areas for growth, but you also focus on normalizations or one-offs. What does this mean? This means that you need to analyze historical figures and try to understand what happened with the company in order to do an appropriate projection, okay? And this happens, one-offs are things that happen only, it's not the normal course of the business. These are things that happen probably only once and that have an explanation, okay? For example, there was a problem with, like now, for example, that we have this very specific situation, coronavirus situation, and maybe some companies had a large stock and then they were shut down for 1 month, and maybe there were some things that had to be thrown away because they do not last a month, because maybe there were like food inventory or things like this, okay? So if you lost all this inventory and you had to assume an expense or a write-off or a write-down, it's a one-off. It's something that you need to do once, that you're going to be assuming this loss this one time, and this is not going to be continue happening all the time. This happened because you had to shut your business for a specific reason, okay? And there are many explanations for one-offs. For example, machine broke down and you were not able to produce as you were doing all the time, and then you repair your machine, but you had 15 days where your machine was broken. Then you need to explain this in your historical figures so that you are not penalized for that specific situation. Obviously, if this is something recurring, then you don't explain as one-off. But if there is a specific explanation, it's good that you explain one-offs or that you normalize the figures to what would have happened if you remove this specific situation, so that you don't make the company look worse than it should, okay? Obviously, if it is a day-to-day type of mistake, or if it's something related to the natural course of the business or of the sector, and you lost business because a competitor took it, then you will not be normalizing it. It's your fault that you were not able to capture that client, okay? So these are normalizations or adjustments that you can do to your figures, obviously explaining them, to try to do an adequate projection based on these normalized or right figures, and you don't take some negative or specific considerations into account. Also, there can be a very positive impact. For example, you were able to sell a piece of land or something in your outside the nature of your business, you will not include it as a regular income because this is not something that you will be doing every single period. So you need to exclude it and normalize the figures and show what your regular course of business is doing, okay? You will exclude it from, for example, if you have a financial, if you're a retail company and you had a very interesting income in some investments that you had in your account, but it's not really related to a specific business, then you need to exclude it as well and explain what this was and why this was a one-off, okay? Okay, great. So let's come back to our P&L projection, okay? Because this is the core of the meetings that you will have, what will be resulting of the meetings that you will have with management and with getting to know the business, understanding the sector, and it will all narrow down to being able to project an income statement, to come down to a projected EBITDA that then you will discount and use as your valuation to have the value for your company. Okay, so there is going to be a strong focus on doing an appropriate and adequate projection of your figures, okay, a realistic one also, because you want to focus really or do what you really believe this company is worth, okay? You don't want to be, this is not going to be necessarily the projections that you will be showing potential buyers. These are going to be the projections that you will use to do your internal valuation, to discuss with your client what the company is worth, to see if you go along with a process to sell the company, if they're okay with a potential range of value. Okay, so here, for example, in this slide, we had historical figures from 2011 to 2014. These are all historical figures: revenues, expense, net revenues, cost of sales, gross profit, SG&A, EBITDA. We could stop at EBITDA really, but here we have all the way down to net income, okay? Obviously, there is a lot of detail behind these revenues because you have to have your depending on what type of company it is. Obviously, you need to build your income or your sales or your revenues, either price times volume, by product, it can be by business line, and then you end up adding revenues, etc. But in summary, you come down to this line, which is historical sales, which you will be projecting, okay? Here you have a 5-period projection of revenues, of expenses, and of EBITDA, okay? And in the bottom, you can see some statistics. For example, revenue growth, expenses divided by revenues, administrative expenses divided by revenues, EBITDA growth, EBITDA margin, okay? So imagine you discussing a lot of detail with your clients. Imagine you discussing a lot of detail with your client the business, the prospects, the potential for growth, etc., 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 and you build up all your model with all the detail, P times Q by product, and you do all your P&L by product, and then you add up, and then in the end, you have your historical figures, which are the real figures, and then your projection for 5 years. Then you sit down with them, or maybe first by yourself, and you review these figures, and you will start to see if the figures make sense or not, okay? Obviously, there are going to be a lot of assumptions behind these projections, okay? So, for example, let's look at revenue growth. It was a company that historically had been growing a lot, 80%, 160%, 60%, 26%. So apparently it was maybe a relatively new company that was starting and was growing very fast. It was growing from 8 million sales to 20 million, 36 million, 42 million. It seems to be sort of stabilizing now, growing from 100% to now 60, now 30. Does it make sense that it grows the next year 15%, then 30%, then it decreases? Obviously, there are a lot of explanations behind, but you need to start questioning yourself. Or maybe, why does it only grow 15% after growing 27%? Or maybe because it's already stabilizing and you see that next year is going to be a bit higher, but more similar, more in line, because it already holds the market share that you're expected to find. But how do you explain then that the following year it grows 26%? There must be a clear explanation for the growth between 2015 and 2016. Okay, obviously there are explanations behind this, and this is one example, but what I want you to see is the rationale behind the questioning that you need to make to understand well these final projections. Okay, what about the next one? Let's look at cost of sales divided by revenues. Okay, so the company is at, or historically, the cost of sales divided by sales or by revenues was 56%, then 67%, then 75%, then 78%. You see, it has been growing as a percent. The costs have been growing as a percentage of sales, but the last 2 years, it has grown less. It's sort of stabilizing at 75, 78, or it's not growing as much. And look at the projection. They're saying, okay, next year, cost is going to be representing 75, so going back to 2013 level, and then it's going to be improving and more or less stabilizing at 73% in the rest of the projection. There must be an explanation, okay? So what I want you to think is, start looking at figures, not only for what the figure represents, but also of what is behind those figures. What's the story behind those figures that are going to let you see if you believe what management and the owners are saying they're going to be able to do or not. And then you can start comparing these statistics or these metrics with competition, for example, with competitors, with a market, with benchmarking with international players. See how this ratio of cost of sales divided by sales in this specific sector for comparable companies looks like. Are they going to be able to behave like them? In what stage are they? Are they a new company? Are they already a company with experience? Are they going to be able to improve their costs or their efficiency, let's say, to manage the company? What about EBITDA margin? The company has done, in terms of EBITDA margin, 15%, 21%, 17%, 17%. So they went a little bit up in 2012, then decreased a little bit, but they sort of seem to be stable between 15 and 20%. I know it's a relatively big range, but between 50 and 20% in terms of EBITDA margin. So very interesting in terms of EBITDA margin, but the projection is between 21 and 22, okay? So they have never done 21 or 22. I think that starting next year, they're going to be doing an EBITDA margin of 21%. I know that they were almost at 21 in 2012, but they should explain clearly what happened in 2013 and 2014 that they were not able to reach these levels, and that they're going to be doing in 2015 and in the projected period, that will allow them to reach the highest margin levels that they had in the historical period, okay? So you start questioning them, and you start questioning the projections, and you start seeing if they make sense or not, to come up with a very credible, robust business plan that has some strong explanations behind, okay? So it's very important that you stop looking at an income statement just at individual figures, and that you start looking at an income statement, looking and understanding the story of the company, okay? The story based on the historical figures, and the potential, the opportunity, the growth prospects for the projection. And see if you believe they are going to be able to do it or not. When you speak with management and they start explaining what they plan to do in the future, you start to see if they know what they're discussing, if they seem credible or not, if you think it's going to be possible for them to maybe they said they're going to be gaining market share, that they hold 10% market share and they're going to be reaching 30% at the end of the period. You say, okay, how are you going to be able to do that if you have this and this and this competitor that are very aggressive? So you need to discuss it in a lot of detail, not only the figures, but the market dynamics, as we saw with Maestro, the players, their potential for growth, etc. Okay, once you have a credible projection of your income statement or of your EBITDA, if it's a financial company, you will do the same with your balance sheet. Okay? Either a bank or an insurance company, you are going to be projecting the whole balance sheet, because after the end of this course, hopefully you will be more familiar with a P&L and a balance sheet of a financial company or of a bank, but you will not be able to do a projection of an income statement for a bank or for an insurance company if you don't project the balance sheet. Why? Because in the balance sheet, in the asset side of a balance sheet of a bank, you will have, I will come back to your question. Give me 1 second to finish the idea. In the balance sheet, in the asset side of a financial company, the main line is going to be your loans, okay, your credits, and in the liability side, your main account is going to be the deposits. And based on the loans that you project in your balance sheet and the deposits that you project in your balance sheet, you will have the interest income that you will get from the loans that you, as a bank, lend, and the interest expense that you need to pay for the deposit that you hold in your balance sheet. So in order to be able to project income in a financial company or in a bank, you need to project your balance sheet as well. Okay, so you will be projecting similar to the income statement. You will be projecting your assets and your liabilities, and as a difference or as a requirement, you will be projecting your shareholders' equity. Okay? Once you have your P&L or your income statement and your balance sheet projected in a similar way to your income statement, you need to discuss with management, only if it's a financial statement, a financial company, some ratios or some statistics for your projection of your balance sheet. Also, to see what is the growth of your loan portfolio, what is the growth of your deposit portfolio, how does the ratio loan to deposit look like, how does the different ratios in the end seem credible or not, how do they look compared to historically what you have been able to do, what does this growth mean in terms of the market share that you expect to gain, what is the current market share that you hold, etc., etc., etc. Okay, these are all questions that you will be discussing with management in order to do this 5-year projection, 3, 5, 10-year projection, depending on the sector and of the industry. Okay, now I will do a short pause and answer this question. Where do I consider the synergies? I don't consider synergies here at all. Why? Because what I'm doing here is the valuation of the company. I'm not doing a valuation of the company depending on who buys or who is a potential acquirer, and what is the level of synergies that each one may be able to have. The only thing that I'm doing is I'm sitting down with my client who is a seller, and I'm going to try to tell him in a fair way how much do I think his company is worth, or at least a range of value for his company, okay? I'm not going to be telling him, I think you can have a potential transaction in this amount because your company is worth this, and there are players that can pay this amount in synergies. I'm just saying, I'm going to be doing an intrinsic valuation of your company and some revaluations for your company, and I'm going to be telling you a range of value at which I think your company is situated and what you more or less should expect in terms of value for your company. I'm not discussing here if I think someone is going to be able to pay or what is a transaction value, only the valuation of the company. Okay, this is a very initial stage with your client. Okay, so once you, I hope I answered properly. Let me know if there is more to your question. And we will discuss synergies and valuation of synergies later on in the course, not now because we're doing just the standalone valuation of the company now. Okay? So to do a valuation, you need your projected EBITDA. You need your projected EBITDA. Here, you don't need all these initial lines. It's well, EBIT plus tax, depreciation, and amortization. You add the first three lines and you have your projected EBITDA. You could also have put your projected EBITDA directly from your income statement here. You could have taken your EBITDA of 10.2 in 2015, and you come here, 2015, and you can add your depreciation and amortization. Okay. Then you project your EBITDA. Oh, this is a DCF valuation, so you need to include your change in working capital, and you need to include your capex or your investments. Why? To have a cash flow projection. Okay, this you know from your valuation courses, hopefully very well. You know how to do a DCF valuation. So project your EBITDA that you bring from your projections of income statement that you discuss with your client. You discuss as well with them working capital and investments required to be able to do these projections for the company. So you say, okay, in order to grow in this way, what investments do I need to do? If I, for example, I'm a company that like Maestro in home improvement, if I'm projecting income from new stores in the future, what is the investments that I'm doing for these stores in each year, etc., etc., and you have your capex projection, like we have here, 6.2, 5.7, 2.7, and come up with a projected cash flow for your 5-year period. Okay, you discount this at your discount rate, which is your WACC, which you also know probably very well how to calculate, and you come up with a firm value for your company. Okay, here you have in this table a sensitivity for the firm value, including based on different levels of WACC and different levels of perpetuity growth that are included in your formula to come up with your value. To this firm value, you subtract the net debt of your company to come up with your range of values for equity value here. And here also you do some sensitivities to the terminal value and some multiples. So let's say to understand better these tables. As a result of this exercise, if we took this company, which had this income statement projected, okay, we take the EBITDA, we also take the projection of the CapEx and the change in working capital explained by management or by the owners, explained obviously to them, and including what we as doing the analysis believe. We discount these cash flows and we come up with a value at a discount rate of 13% and a perpetuity growth rate of 2.5% of 61 million for the company, okay? If we subtract the net debt, which is the debt that they hold in their company minus the cash available, we come up with an equity value of 40 million, okay? So if the company is worth 60 million and the equity value is worth 40 million, then it means that they have a net debt of 20 million, okay? What is as part of the valuation? The terminal value, 44 million out of 61 million. What are the multiples implied for this valuation? So 61 million firm value, I'm sorry about that, 61 million firm value divided by 2014 EBITDA of this company, so real figure, I get a multiple 8.5 times. So 8.5 times firm value to EBITDA. What is the firm value of 61 divided by the EBITDA, projected EBITDA for 2015, which was, I think it was 10.2 that we saw in the table. What is the firm value to EBITDA of the first projected year? 6 times, okay? So we will be in a multiple range to EBITDA of 8.5 in the first year and 6 times in the second year. So then, when we finalize this, obviously, to be able to do this DCF or this discounted cash flow valuation, we need to use a WACC, which is calculated, as you know very well, based on cost of equity and cost of debt. The cost of equity, have a detailed an example of what was used at that time in the calculation. We had a cost of equity of 11%, 11.6%, a cost of debt of 5.6%, and then using a mix of equity to debt of 86 and 13% based on probably the comparable companies mix, we had a WACC or a discount rate of, in this example, of 10.8%. So the discount rate that was used was, in this example, maybe it's a different presentation, but this is an example of a WACC, and then you calculate your sensitivities based on a range. So for example, if this is 11%, you can use a range of WACC of 9.5 or 10 to 11, and you go 0.5 and 0.5 intervals, or you can go, for example, from 9 to 12 and position your 10.8 in the middle of your table. Okay, what are other, so with that, you finish, let's say, with your DCF valuation for your company. Then I will show you some output tables that are usually prepared to discuss with your client, valuation, okay? So one thing is the DCF or the DDM if it's a financial company, and of your company, which more methods are the ones we discussed last class, which are reference valuation metrics, which are, for example, your trading comps, your transaction comps, your regression analysis, etc. So we will see in a lot of We will see in a lot of detail valuation next class, so please try not to miss next class, and I hope that everyone is able to join, or if not, listen to the presentation afterwards, because tomorrow next class is going to be probably the most technical class, and we will go into a lot of detail, and then we will review exactly what you need to do with the templates and everything for the following class assignment. So please try not to miss next class, okay? And we will see all these valuation methods in a lot more detail. Okay, now today we have like an overview. And obviously I'm assuming that most of you already know all the methodology behind these methods. Okay, if not, we will discuss them in a lot more detail next lesson. Okay, another question. When you present evaluation, do you assume that the client already knows how the DCF works? No, not necessarily. Usually, most CFOs know pretty well how a DCF works, but not necessarily everyone in the company, not necessarily all CEOs or all owners know. So you can explain, no problem. You can explain what you used and you give some info on the theory, but you don't really need to focus a lot in the theory. What you need to do is explain what you have done. So what I would do is I would explain how we projected the P&L and the assumptions behind it. I would explain how we project the balance sheet and the assumptions behind it, what we are considering in terms of investments or CapEx. I would say, based on these figures, we had discount them using the common practices to do a discounted cash flow valuation, and we come up with this range of values for this level of discount rate. You can discuss with them how you come up with the WACC if they have a very different view. In reality, if you have all the required backup and analysis behind, you should be able to respond and explain very well how you come up with a range of value. Okay, so then we would probably discuss trading comps. Okay, so here you have an example of a page of trading comps. This is for companies providing equipment. So, for example, Caterpillar, Komatsu, etc. At what levels they were trading, what is their market cap, what is their firm value, what is their last 12 months sales, what is their margin EBITDA, what is their net margin, and then some multiples for the last 12 months and for 2 years in terms of sales and in terms of firm value to EBITDA. So just to look at this example, we have this range of companies, the location, so worldwide or first world countries, US, Sweden, Japan, China. And then you see, for example, these companies are able to do EBITDA margins of, well, some of them are 4, 5, 7%, and some of them go as high as 22%. So maybe you need to see which one is more comparable to your own company in terms of size, in terms of market cap, and in terms of the margins that they are generating. What are their level of multiples? For example, let's look at the first projected year, firm value to EBITDA for 2015. The multiples are going from 6.2 to 12.2, and the median is 9.3, and the average is 10 times. So you could see that in this sector, the multiples are pretty stable between 9 and 10 times for the last 12 months and for the first projected year. This is probably another sector, so maybe this company is this client is present in 2 segments, so providing equipment and construction engineering. And here are some other companies in this specific sector: Fluor, CITIC, Tyson, etc. And the same, their countries, market cap, margins, and multiples. Here you can see in this segment, the multiples are closer to 8 times for the last 12 months and closer to 6 times for the projected year. Okay, so you would have then the outcome of your DCF, you would have what trading comps are doing, you would also have transaction comps if there have been transactions in the sector. So you here have, for example, in the same sector of equipment, you have the different transactions that have happened since 2008 to 2014. Foster Wheeler being acquired by AME, Hens being acquired by CNC, and us, How being acquired by Rojo, etc. Okay? So, what is the enterprise value and what is the enterprise value to sales and to EBITDA and the multiples? Here you have medians from or average between 8 and 9 times for EBITDA multiples, while the comps were 9 to 10, I think. Yes, 9 to 10. Here you have 8 to 9, but relatively close. Okay, so then you can compare how these multiples are looking compared to your own DCF and see if it makes sense. Maybe if you have higher multiples, it's because your company operates in a market that potentially has more potential for growth. Or maybe it's in an earlier stage. Or maybe, I mean, there should be some explanation if you are too far away from multiples in the sector if companies are really comparable. Okay, another example of M&A transactions, transaction comps. And then here is a slide where I want to stop a little while to discuss in a little bit more detail what would be a typical output page for a presentation when you are discussing valuation with your client. Okay, so I will be leaving the camera on because I think the connection is working properly. So if anyone has a bad connection due to camera, please let me know. If you think it works better when I turn it off, and I will turn it off. Okay, so imagine we do as a banker or as advisor the analysis for this company, for your seller, the evaluation exercise with management, etc. And we come up with our DCF analysis. And we also bring the trading comps and the transaction comps. We would, after, in the end, or maybe depending how we structure the presentation, discuss a page similar to this. A summary of a preliminary valuation. This is a case example, so this is why I'm bringing it to you here. And this is a particular example. Maybe I have 1, 2, or 3 in this presentation, but let me show you this specific one as a way of an explanation. So what did we have in this case? Considering the difficulties in the valuation mentioned for the target, and given the volatility and uncertainty of the cash flows, we present the results of our preliminary valuation calculated using the following methodologies: DCF, trading comps, and transaction comps. Based on this analysis, we estimate a range of value of firm value between $100 and $115 million for this company. Okay, and here you can see that there are 3 methods in the 3 different boxes: DCF, trading comps, transaction comps. Then you see a range of value for each of them. So for the DCF, you have 105 to 120 range with a midpoint of 112. For the trading comps, you have $74 to $98 million value range, and for transaction comps have 86 to 110 value range. Okay, the selected range, as you see for the company, is higher than the trading comps, and in the, let's say, in the upper range or higher range of the transaction comps, but a lot more in line with the DCF. And here we are mentioning in the introduction that it has been a difficult company to do projections because it's highly volatile, their cash flows are very volatile, and there is a lot of uncertainty of these cash flows. So maybe they are not that comparable to trading comps or transaction comps, and these are here more for reference, and the range is more based on the DCF valuation brought. Just to finish explaining this slide, and then I will come back to your questions, okay? So the range of value for this DCF also shown here in the right, the implied multiples for this of value and for the midpoint, okay? So firm value to sales, firm value to EBITDA in 2014, and firm value to EBITDA recurring, which is an adjusted EBITDA, maybe because this company is so volatile, we had done a recurring EBITDA. Okay, so what we can see here is the implied multiple to EBITDA of the DCF has a midpoint of 9.2 times, while the trading comps have a multiple of 7 times and the transaction comps of 8 times. So basically we're saying that this company, what we think is that this company is probably more in line, the valuation is more around 9 times more than the sector that is around 8, 7 or 8, okay? There is another example here, but let me have a quick look at your questions. What about if the company operates in a niche market and there are no comps? How can you find the industry? Okay, so if there are no comps, first of all, you will not have reference valuations. So you would focus only on your own DCF and your own intrinsic valuation, okay? Here, and obviously you can always have some sort of reference from the market from similar type of companies if you want, and maybe not include those in your range, but just have them as reference. If you think they should be valued lower or higher, you can put them as reference, but don't include them then in your final rate. Or you can just say, look, there are no transactions that have happened in this sector. There are no M&A comps at all, so you don't include that reference. Let's see this example, and I think with this example, we answer perfectly well your question, okay? So in this example, you have 3 blocks: the DCF, trading comps, firm value to EBITDA 2014, and trading comps, firm value to EBITDA 2015. So here, for trading comps, we took 2 ranges. Trading comps for the current year and trading comps for the projected period. Okay, apparently there is a lot of difference or expectation or projection for a different projected year. So, and there are no transaction comps. Okay, and let's look at the comment. We estimate firm value in the range of 53 million to 61 million, which are the 2 red lines, okay, based on DCF methodology and adjusted trading multiples. The midpoint value of 57 million results in a firm value of, so the midpoint value of 57 is the point between the 2 lines. You can decide, after doing the analysis, that you only take into consideration DCF. You can decide that you believe that even though this is the range that you get from your DCF, you feel more comfortable within a lower range, or maybe this range is too large, from 50 to 70, and you might think you will be positioned in the lower end because your multiples are there, historical multiples are there. But there should be some explanation or some analysis to back up your conclusions, obviously, no? And you will only have this after understanding the market, particular company, how the company is positioned within competition, within other players, within the multiples, etc. Okay, but I think there was a part of your answer I didn't answer. How can you find the beta? Well, one thing is the beta that you're going to be using for your WACC, for your discount rate, for your DCF, and the other thing is the trading comps and the transaction comps. I only answered about the trading and the transaction comps. Okay? For beta, I mean, the beta is that the difference between your sector and the market. Okay, so if there is no sector trading and you cannot find any difference in the market, then it's going to be very difficult. But it's going to be very strange that there are no real comparables. Even if they're not that comparable, you can look for global companies. I mean, it's very difficult that there are no companies doing what you do. Okay, I mean, you have to be like really inventive or extremely creative to be in a sector where nobody is, or to be in a specific industry where nobody plays. Maybe in your specific niche market, there are no other players, but then you can look at the whole industry or the whole sector, even if it's not specifically your own niche. And then you can look at players in your same industry, how they are behaving. And then assume and use their multiples and use their beta and everything. And then you can assume that because you are in this specific niche, maybe your range of value should be positioned lower or higher in line with your DCF. And then you would have the explanation if you have the range of your DCF, because you have more growth potential, because you have higher margins. Obviously, all this, you need to have some backup to make all these assumptions, no? So probably we will see it in more detail when we see specific examples, but I hope I answered. How do you define the range for the DCF? Does it come from the sensitivity analysis? Yes, usually the range from the DCF, and obviously, I mean, valuation in general is very subjective. It will depend on what you take and the decisions that you make and the underlying assumptions. So two different people can be doing a valuation of the same company and can be having very different ranges and values. So it all comes down to how well you are able to defend your position and how credible you think your plan is, and how much you think management is going to be able or not to do, and what views you have in the future of the company. So in the end, your future cash flows that no one has any idea if it's going to be true or not, if you're going to be able to bring them or not. So there is a lot of, let's say, unknown in these predictions, and so a lot of art and also imagination. I mean, you as long as you can justify and explain what your thoughts and your rationale is behind this projection, it's fine. Maybe you come up with these projections and then you sit down and discuss with your client and management, and they say, no way, impossible. We will never be able to do this level of sales, even if we get this and this and that. So then you have to start adjusting, and come up with projections where everyone more or less feels comfortable with. So maybe you say like, look, I think we have reached our peak and this is what we will be able to do. And I see very little potential for this business in the future. If we don't go into other businesses, this is our cap. So maybe you have to project that cap and maybe the value for that company is not that high, okay? But this is a discussion that you will have to be doing with the seller, with management, and that you're going to be refining and adjusting and changing until everyone more or less feels comfortable with all the assumptions or most of the assumptions we have, okay? And the range of the DCF is based on the range of WACC and growth that you assume. If there are other metrics that are more important, you can also use them for your range of value. For example, if there is a strong element of pricing or of market prices in your production, for example, if you are doing the valuation of a mining company and they depend on the prices of some specific metals, probably your valuation is going to be subject to a sensitivity table on the range of price for that specific metal, okay? Obviously, it will depend on the sector. Okay, you will also discuss with your client, your potential buyers that we reviewed last lesson. And basically with that, you will finalize the internal preparation before you launch a process, okay? So you will discuss valuation, you will do your DCF, you will have your reference valuations, you will discuss in a lot of detail. You make sure everyone feels more or less comfortable with the range of value you're coming up with. If not, you can discuss and rediscuss and again the different assumptions until everyone more or less feels comfortable with what you are considering. And then you finalize the exercise with a range of value in everyone's head. So in the seller's head, in management's head, and you as an advisor, okay? Once you have this range of value and your client feels comfortable with this range of value, then you can agree to go along with a process. Because if you don't agree on a range of value and you start a process, then this process can be easily frustrated because you go ahead with a process, then potential buyers will have different views on the value of your company, and you don't want to have a disagreement with your client in terms of value afterwards, after launching all the process and doing a lot of work. You want to discuss with them that if you are able to potentially sell in this range of value, they would go along with a process, with a sale. So you basically agree with them that in this range of value or in the higher range or in the lower range, they would be okay with going ahead with the process. Okay, this is important to set expectations for everyone. Okay, you would also discuss who the potential buyers for the process would be, who you would be potentially inviting for a process. You can discuss, as we saw last time, in a lot of detail each potential buyer, see if you are okay in inviting all of them, some of them, only a few of them, what kind of process you want to do, and then you would be ready to start launching a process, okay? We will review in a lot more detail next class evaluation exercise, the different valuation methods, and you will be preparing the first deliverable for this course, which will be the evaluation exercise by groups, only based on some of the methods that we will be discussing next class. And I will show you now what the case simulation, the case study, the case for the course will be, and the different dates for these deliverables, and what we will be reviewing next class, okay? So, For the rest of the course, remember first class, we had an introduction, then we reviewed the case study of Maestro, then we did an explanation of what an M&A pitch is in a way of introducing an M&A process, and today we started with the internal preparation of the company. This is the first section. Then we have marketing, non-binding offers, due diligence, and binding offers. These are all the different stages of an M&A process. So we will follow our course with a structure of a typical process, as I mentioned before, and we will be doing a full M&A case from now on, okay? So there are going to be 3 deliverables in this course. One is going to be the evaluation, which is going to be a 2 to 3 slide presentation per group. This is going to, all the deliverables are going to be done by groups. So the first one is going to be the evaluation. You can see them here in bold with the stars. So internal preparation, we will have the evaluation, and here we have the first deliverable, which is going to be the presentation. In marketing, we will have no deliverables. In non-binding offers, we will have another deliverable, which is going to be a 2-pager with the non-binding offer that you will be doing as part of the case simulation. Then we will be discussing due diligence, and then we will have in binding offers the final deliverable, which is going to be also a 2-pager, everything in groups, which is going to be the binding offers. Okay, so we're going to be simulating an M&A case. So first we're going to be doing valuation, then we're going to be discussing marketing, and then I'm going to be asking every group representing a potential buyer, and is going to be presenting a non-binding offer. Sorry, there was some echo there. And this is going to be the midterm exam, and then all groups are going to be presenting a binding offer, which are going to be the final exams, okay, by groups. So all in all, the group assignments are 1 presentation, 2 to 3-pager, and 2 written offers or papers, which are going to be also 2-pagers in a way of a term sheet or an offer. We will discuss in more detail when we come down to that. But okay, so this is going to be our case simulation. We're going to have 5 groups, 5 to 6 students. You can send them, you can send me, you can get together in your own group you want. You can send me your groups today, tomorrow, but before next class. If by next Tuesday I don't have you or anyone in a group, I will assign the remaining people in different groups so that everyone for next class will know in which group they are and with whom, okay? So we will have 5 groups, 5 to 6 students. Email me your groups if you want, if you know other people in the class and you want to be with them. And if you don't know anyone in the class and you don't know how to get in a group, don't say anything and I will assign you to a group, okay? The first presentation or the first deliverable is going to be in 2 weeks' time, so 29 September. And next class, we will be discussing or reviewing in a lot of detail the different evaluation methods. So you will know very clearly, and I will give you a template in Excel that is going to help you, and also maybe a template in PowerPoint that you can use to present your 2 to 3 slides, or you can use your own if you prefer, okay? So next class, we will be focusing on assignment number 1 for valuation, but I also give you some information regarding the other assignments, the 2 written papers will be for 13 October and 17 November. This is going to be the midterm exam and the final exam, which are assignments in groups, okay? So the first assignment for 2 weeks' time, we're going to be doing the evaluation of Banco GNB, which is a Peruvian bank. We will have all the information in the regulator webpage and in the templates that I will give you, okay? The evaluation exercise will be done in this way. Groups 1 and 2 will be doing trading comps and regression analysis. Group 3 and 4 will be doing cost of equity and transaction multiples. And group 5 is going to be doing the EVA analysis. The specific deliverable for this assignment is going to be 2 to 3 slide PowerPoint plus the Excel workbook that you use to prepare these slides. You will need to be sending it via email the same day of the presentation or in 2 weeks' time before 5 p.m. so that for our class at 7:30 p.m. I have all the documents and I can share them or project them and we can discuss them in class. Someone in the group, either all of you or one of you, as you prefer, will be presenting these 2 to 3 slides, okay? Assignment number 2 is going to be for 13 October. It's going to be a 2-pager, as I said, for your midterm exam, and assignment number 3 for 17 November, the binding offers, also a 2-pager, your final exams. Okay, so hopefully everyone has a better idea of what will need to be handed in. We will discuss in a lot more detail, as I said, next class, the pages in PowerPoint and Excel that need to be considered for trading comps, regression, cost of equity, transaction comps, and EVA. We will discuss in the class what each of these valuation methods is exactly, specifically the EVA analysis and the regression analysis that we haven't yet discussed. And obviously, you can ask either next class or during the week before you need to present the slides, okay? I don't want anyone in the class to be doing too much work, in the sense that I want people to, in the group or students, to start to be practical and to have common sense and to use what is publicly and openly available, and to try to be practical and to think, if I have to present something tomorrow or in 2 days' time, what would I do? How would I prepare it? How many people we are in the group? How can we divide this work? And how can we do it efficiently? Okay? So we will be discussing this presentation, as I said, or this deliverable in a lot more detail next class. But if you do have any specific examples, let me know now. If you already know who you would like your group to be, or you are already discussing it, send me your names and I will answer as soon as I have the groups, which group number you are. Please don't to get together with your group. If you are, for example, 5 or 6 people, or 4 or 5 people, send me your group, ideally with 5 or 6. And if not, as I said, I will make sure that you all have a group for next class. Okay, so we should start next class and everyone should have a confirmation in which group they are, so you should all know what slides you will be preparing for the following lesson, so you can pay obviously attention to the whole class, but even more so to the slides that you need to prepare, so that you have very clear idea of exactly what you need to do. Okay, I will be sharing with you, as I said, even an Excel template specifically for regression and EVA that are the most difficult ones, let's say, not difficult ones, but maybe the ones that you know the least. okay? But everyone, and then after your presentations, I will be sharing with all the groups all the presentations and all the Excel files so that all groups have all the information and that they can use them in order to present their offers in the future, to adjust, to change, to improve, and only then I will be telling you who you are as a potential buyer so that it can be confidential and that everyone can use not only the valuation methods that they were required to use for their assignment, but also that they have the Excels and everything available for all valuation methods so that they can adjust and use as they prefer, change, etc. You will not be needing to present them afterwards. The methods is just for you to make sure to move them or to change them or to have them as information to come up with a value that you will present for your offers in the future. Okay? So please, this is all for today. Please let me know if you have any other questions regarding today's class or any specific questions that are not clear regarding what we are going to do, and I'm more than happy to answer them now or via email if you prefer. Okay? If there are no further questions, I wish you all a very good, nice week. Please send me your groups, those of you interested in being in a specific group or with some specific colleagues. And thank you for your assistance to